2 weeks ago, Elon Musk's SpaceX went public. It raised $75 billion in a single day. The stock opened at $135 a share and closed 19% higher. Within a week, it was trading above $200. The biggest IPO in American history. And here's what most people missed in all the excitement. A slice of SpaceX is likely heading straight into your retirement account, whether you bought a single share or not. I'm not talking about something that might happen someday. I'm talking about something that is happening right now, this week. Inside funds that millions of Americans hold in their 401k plans and IRAs. And depending on which funds you own, you might want to pay attention to what this actually means for your retirement savings. Today, I'm breaking down exactly what's happening, which accounts are affected, which ones aren't, what the real risk is, and the 3 questions you should be asking about your own retirement account right now. Let's start with why this is even possible. Most people who invest in a 401k aren't picking individual stocks. They're putting money into index funds. Funds that track the S&P 500, the nasdaq 100, total market funds, target date funds. These funds don't make judgment calls. They're built to automatically own whatever is in the index they track, which means when a new company gets added to an index, every fund that tracks that index has to buy it automatically, whether anyone asked you or not. That's normally a slow process. Most companies have to wait 12 months of public trading and prove they're actually profitable before joining a major index. SpaceX didn't wait. Here's what happened behind the scenes. Earlier this spring, before SpaceX even went public, index providers quietly changed their rules. Nasdaq changed their rules. FTSE Russell changed their rules. CRSP changed their rules. The new rules said that if a company is large enough, it can skip the waiting period and enter the index within days of going public. SpaceX is large enough. At a valuation of $1.77 trillion, it's one of the most valuable companies on Earth at its debut. So the rules were changed, and SpaceX walked straight in. Now let's talk about which accounts are actually affected, because this is where it gets specific. If your 401k or IRA is primarily in an S&P 500 fund, you are not affected right now. The S&P 500 stood firm. They did not change their rules. SpaceX cannot enter the S&P 500 until it has been publicly traded for at least 12 months and posts 4 consecutive quarters of profitable earnings. SpaceX reported a net loss of $4.9 billion in 2025. It is not currently eligible for the S&P 500. Since roughly 80 to 85% of index money in retirement plans tracks the S&P 500, most retirement savings are protected from immediate SpaceX exposure. But here's where it gets complicated. If you hold a total market fund, SpaceX is coming. Vanguard's total stock market fund can add SpaceX as early as 5 trading days after the IPO under their fast-track rules. If you hold a nasdaq 100 fund, like QQQ, SpaceX can enter within about 15 trading days. If you hold a Russell 1000 fund, SpaceX will likely be added at the September or December reconstitution later this year. And if you hold a target date fund, which automatically allocates across multiple indexes, you may have exposure through any of those underlying funds. So what does this actually mean in dollar terms for a regular retirement saver? Let's say you have $100,000 in a total market fund. SpaceX, at a valuation of $1.77 trillion, represents roughly 2% of the total US stock market. That means your $100,000 fund would hold approximately $2,000 of SpaceX. 2%. Now some people hear that and think, great. SpaceX is up 30% since the IPO. That's a nice gain, and that's true. If SpaceX continues to perform, having it in your fund is a good thing. But here's the honest question you need to ask yourself. SpaceX has never been consistently profitable. It lost nearly $5 billion last year. It went public at a valuation of $1.77 trillion. For comparison, that's larger than Amazon was when Amazon was already one of the most dominant companies on the planet. Is that the right price? Maybe. SpaceX is genuinely extraordinary. Starlink alone has 50 million subscribers. The rocket business is unlike anything that existed 5 years ago. But you didn't sign up to make that bet. Your index fund made it for you. And here's something that should concern you even more than SpaceX specifically. This isn't just about SpaceX. Anthropic is expected to go public in 2026, valued at nearly $1 trillion. Same fast entry rules will apply. OpenAI has indicated it plans to go public within the next year or two, potentially valued even higher. Every one of these companies will enter major indexes within days of their IPO under the new rules, which means your retirement account, your carefully balanced index fund portfolio, is being restructured around the biggest and most expensive new companies in history, automatically, without your input. Several state officials pushed back on this. The New York State Comptroller, the New York City Comptroller, Illinois, Maryland. They all wrote formal letters to FTSE Russell and NASDAQ asking them to pause these new rules until someone did a proper analysis of the impact on retirement savers. Those letters were ignored. The rules stand. SpaceX is in, Anthropic is coming, and your 401k will reflect all of it. So, what do you actually do with this information? 3 questions to ask yourself right now. Question 1. What index funds am I actually holding? Log into your 401k account today. Look at what funds you own. If you hold a total market fund, a NASDAQ 100 fund, a Russell fund, or a target date fund that holds any of these, SpaceX is either already in your account or will be very soon. If you primarily hold an S&P 500 fund, you're not affected right now, but watch what happens over the next 12 months as SpaceX works toward profitability. Question 2. Does this change my risk tolerance? For most people, 2% exposure to SpaceX through a diversified fund is not a crisis. Vanguard's own chief investment officer said it well. Mega IPOs reinforce the value of diversification. Even the largest company represents a small piece of a truly diversified portfolio. But if you're within 5 years of retirement and you are counting on the relative safety of index funds, adding an unprofitable $2 trillion company that's been public for 2 weeks is worth thinking about. Not panicking about. Thinking about. Question 3. Should I change anything? For most people, no. The honest answer is no. Selling out of a total market fund because of SpaceX exposure would mean giving up diversification across thousands of other companies to avoid 2% in one new one. That math rarely works in your favor. But if you are close to retirement, if 2% volatility keeps you up at night, it is worth a conversation with a financial advisor about whether your current fund allocation still matches where you are in life. Not because SpaceX is going to destroy your retirement, but because this moment is a good reminder to actually check what's in your retirement account instead of just assuming it's fine. One more thing before we wrap up. There's a lot of noise right now about SpaceX. The excitement is real. The 30% gain in 2 weeks is real. The Starlink business is real. The rocket achievements are genuinely remarkable. But there's a difference between admiring a company and betting your retirement on it at a nearly $2 trillion valuation before it's ever turned an annual profit. The index providers made that bet for you when they changed the rules this spring. Whether it turns out to be a great decision, a fine decision, or a decision someone will be writing critical articles about in 5 years, nobody knows yet. What you can control is understanding what's actually in your retirement account and making sure the decisions being made on your behalf are decisions you can live with. That's the part that's worth your attention. I'm George. See you in the next one.